In this video, we're talking about qualified retirement plans, how they evolved, and how they show up on the CFP exam. Now, if you saw my previous video, you'll know that there are three primary types of retirement plans: government provided, employer sponsored, and individual retirement accounts. In our video about government retirement funding, we talked about how for nearly half of seniors, more than 50% of their household income comes from Social Security. But what about the rest? Well, many Americans rely on employer-sponsored retirement plans. But the employer-sponsored plan system we have today, well, it looks nothing like what existed 50 years ago. Back in the 1950s and 60s, if you worked for a large company, the retirement deal was simple. Work for 30 years, get a pension, and the company promised you a specific monthly check for life. Maybe it was 60% of your final salary, $200 per month for every year of service, or some combination thereof. The formulas varied, but the promise was clear. The company took care of everything. They hired professional money managers, set aside funds for each year, and made sure that there was enough money to pay everyone's benefits. If the investments performed poorly, well, the company had to chip in more. If you lived to 100, the company kept paying. And if the stock market crashed the year you retired, well, your pension check stayed the same. For most American workers, retirement planning was simple. Work at the same company for decades, and you'd be taken care of. But then came the perfect storm. Pension funds had existed in the US since the late 1800s. American Express introduced the first private sector pension fund in 1875. Other companies, particularly those in railroads, banking, and utilities, created pensions to encourage stable, long-tenured employment. But there were cracks. Plan benefits were all over the place. Some lacked vesting requirements, meaning if workers left before retirement age, regardless of how many years they'd worked, they received no benefits. Others had overly stringent vesting requirements, like vesting at age 50. Some had no surviving spouse benefits, and there were rising concerns about underfunding and outright fraud in the administration of pensions. In 1963, Studebaker, once a premier automaker, filed for bankruptcy. The company had been in stress for a while and had massively underfunded its pension. More than 8,500 auto workers lost all or most of their retirement savings. In response to this and other such incidences, Congress passed the Employee Retirement Income Security Act, or ERISA, in 1974. The goal was to provide better oversight of pensions so that things like Studebaker never happened again. ERISA created vesting requirements, funding standards, and fiduciary responsibilities to protect workers. But it had unintended consequences. Pensions became much more expensive and risky for employers to maintain. Suddenly, companies had to guarantee funding levels, follow complex reporting requirements, and face potential liability if anything went wrong. Much like banking oversight legislation that came post-2008 financial crash, the pension administrative burden exploded. Now, you might be wondering, if ERISA made pensions so complex and expensive, why didn't companies just create their own plans outside of this system? Well, here's the thing. ERISA has a trade-off. Yes, pension funds now had large compliance burdens, but they also offered something incredibly valuable: tax advantages. And if companies followed ERISA plans, their plans were considered qualified plans under the tax code. Qualified status meant three huge benefits. First, the company could deduct their contributions immediately. The value of this cannot be understated. For large enterprises, these tax benefits alone could be worth millions of dollars each year. Now, of course, there are limits. You can't, say pay yourself $1 in salary and put $500,000 into a qualified retirement account. Nope, there are tax deductions, and those are capped at 25% of the employee's compensation, up to an includable comp of $350,000 for 2025. That number, by the way, is on the exam table, so you don't need to memorize it. Now, on top of being able to deduct contributions, companies don't have to pay payroll tax on those contributions. That's the FICA tax that funds Social Security and Medicare. To be clear, employers don't need to pay their portion, but the employee contributions are still subject to FICA. However, employees do get an advantage, and that is our third tax advantage of qualified accounts. Employees can defer income tax on their own contributions until retirement. And since most people make less income during retirement, this also has the added benefit of getting taxed at a lower bracket than if they were simply to receive the money now as W-2 income. This triple tax advantage makes qualified accounts amazing carrots for companies' employees. But to qualify, you have to follow all the rules. You can't just give benefits to executives or owners. You have to cover rank and file employees, which means complex non-discrimination testing. You have to have vesting according to strict schedules. There are plenty of rules, and we'll go over those in a specific qualified plan administration video in the future. Now, fundamentally though, companies faced a choice: stick with the expensive regulated qualified pension plan system to get the tax benefits, or abandon those tax benefits entirely and create non-qualified plans just for executives. Now, most chose to stay in the qualified system, but they desperately needed an alternative that was simpler and less risky than traditional pensions. Enter Ted Benna. In 1978, Congress passed a small tax code provision called, you guessed it, Section 401k. It was buried in the Revenue Act, and it was originally intended to help some executives at Kodak refer their bonuses. But Ted Benna, a benefits consultant in suburban Philadelphia, was reading through the tax code, because who doesn't do that? And he realized that this provision could be used to create an entirely new type of retirement plan. His idea was radical. What if employees could contribute their own money to a retirement account on a pre-tax basis? And what if the company simply matched those contributions instead of promising a specific benefit? The first 401k plan was implemented just a few years later, and companies quickly realized that they had stumbled upon something revolutionary. Instead of promising a defined benefit for life, they could provide a defined contribution and then walk away. Suddenly, longevity risk, the risk that someone would live longer than expected, it shifted to the employee. The contribution burden largely shifted to the employee, and the investment risk shifted to the employee. And with all of that, much of the administrative complexity for companies disappeared. From the company perspective, this was brilliant. Predictable cost, limited liability, and if employees didn't save enough for retirement, well, that wasn't the company's problem anymore. Now, remember, Section 401k was a minor add-on to a much larger bill. It was not meant to benefit anyone except for a handful of folks in upstate New York. This wasn't some grand transition. There was no grand plan. But slowly, company by company, year by year, employers realized that they could shift risk and reduce costs by replacing their pensions with 401k plans. The result is the system we have today, a system where individuals are primarily responsible for their own retirement security, making investment decisions, managing market risk, and hoping that they don't run out of money before they die. Now, I've walked us through this little history lesson, not because it's going to show up on the exam, but I share it because it explains why retirement planning today is so complex. We are not dealing with a system that was designed from scratch to be optimal. We're dealing with the unintended consequences of what was originally a small tax provision. All right, so now that you have that in mind, let's talk details, starting with pensions, the OG retirement vehicle. In our taxonomy of retirement plans, pensions sit under qualified plans, which is a type of employer-sponsored plan, which is just one of three primary sources of retirement savings. Now, I actually debated whether we start with pension versus profit sharing, or instead start with defined benefit versus defined contribution. Both are correct ways to dissect the world, but it makes things a little confusing because actually these terms are not MECE, meaning pensions can be DB or DC, and alternatively, DC plans can be profit sharing or pensions. A better way to visualize all of that would be to draw overlapping circles. That's not really an intuitive way to remember these things, at least for me. So I decided to start with pensions versus profit sharing. Why? Well, DB versus DC is pretty straightforward, and we will talk about that difference in a bit. But the defining attributes of pensions and profit sharing are less obvious from just their names. And those differences, they will definitely be tested. So, what makes a retirement account a pension? Well, as I mentioned earlier, it is not that all pensions are defined benefit plans. And that's certainly what I thought before I started studying for CFP certification. I thought that pensions basically were annuities for union workers. And while that may be generally true, it is not precisely true. Instead, pensions are defined by a few things. The first is that the employer is required to make annual contributions. This is a big freaking deal. Employers must fund the pension every single year, rain or shine, profit or no profit, which means this kind of retirement plan is better suited for more established companies with reliable cash flow. Not only that, employer contributions are usually the only contributions to the plan. And when we talk about the 4 different types of pension plans, we're going to talk about how there's only one, money purchase plans, that allow employees to contribute. For the other 3 types of pensions, only the employer is funding the plan. Second, pensions must limit their investment in their own company stock. Remember Studebaker? Well, if the company is going bankrupt and all of its pension funds are invested in its own stock, that is a spiral of doom. No, pensions are only allowed to invest 10% of the fair value of plan assets in their own securities, and that includes both stocks and bonds. Third, pensions generally do not allow in-service distributions, meaning you cannot withdraw funds while you are working for the employer. Now, technically, this changed during the Pension Protection Act of 2006, which allows for in-service distributions if the employee is 62 or older, but in practice, this rarely happens. Lastly, pensions must provide qualified joint and survivor annuity or QJSA benefits. What does that mean? Well, if the participant dies, their survivor receives ongoing benefits. These can be no less than 50% of the original participant's benefits. Now, a participant may opt to waive QJSA. That's something we'll cover in another video about plan distributions. Okay, so those are the things that make a pension a pension. But what about the other type of qualified plan? What makes a profit-sharing plan a profit-sharing plan? Well, before we get there, let me call your attention to a link in the description and comments area. If you are a super diligent type A person who's taking notes right now, I have made a worksheet to go along with this video. If you're not so diligent but still want to pass the exam, I recommend printing out the sheet later today and filling them out based on your memory. Then compare them to the answer key. Yep, I made an answer key. And notice what hasn't lodged in your memory yet, or maybe what has lodged incorrectly. Finally, if you are lazy but you're still hoping to pass the exam, yes, you can simply print out the answer key. All I ask is that you hit the like button on this video. All right, back to profit sharing plans. These should be pretty straightforward, right? It's a plan that allows an employer to share profits with their employees. Pretty easy peasy. Yes, and for ERISA and other purposes, there are a few other things that define a qualified profit sharing plan. To get those sweet, sweet tax benefits, there must be a predetermined formula for allocating shared profits. Remember, ERISA really cares about protecting rank and file employees. A profit-sharing plan cannot simply distribute profits to the top executives. And in almost every other way, profit-sharing plans are much more flexible than pensions. They do not, for example, require mandatory annual employer contributions. Again, big deal. Where pension funds require the employer to contribute each year, profit-sharing contributions are discretionary and only need to be substantial and recurring. So not every year, but most years. This is generally interpreted as contributions for 3 of the last 5 years. This flexibility is great for companies that are relatively new or where profits might vary a lot from year to year. Profit-sharing plans can also invest up to 100% of the plan's assets in the employer's securities. Wait, what? But what about concentration risk? Well, all profit-sharing plans are defined contribution, meaning that individual employees are responsible for managing the investments in their accounts. So the company can contribute cash or they can contribute company stock, and then it's up to the employee to decide whether or not to convert that stock into cash. Spoiler alert, they should. Now, profit-sharing plans, they also allow in-service withdrawals after 2 years of service. If they do, that would be in the plan documents. And finally, profit-sharing plans are not required to have survivor benefits. Again, as a function of them being defined contribution plans, the employer has no lingering responsibilities. There's no lifetime annuity that they're on the hook for. So if you die, your beneficiaries get whatever money is in your retirement account, nothing else. So given all of that, it's not hard to see why companies now have profit-sharing plans and not pensions. All right, so far we've talked about the advantages of qualified retirement plans. We've divided them up into the broad categories of pensions and profit sharing, and we've talked about the attributes of each. Now let's go one click deeper and talk about defined benefit versus defined contribution. Now, as I mentioned earlier, these don't perfectly map to pensions and profit sharing. That's because pensions can either be defined benefit or defined contribution. There's two of each type. And all profit sharing plans, they're all defined contribution. We're going to talk about what DB and DC mean before we go over the individual plan types. Now, for defined benefit, the name pretty much tells you everything. The benefit, or the amount of money you get at retirement, is defined. The company promises you a specific monthly payment for life, usually based on a formula involving your salary and years of service. These formulas can vary, but the key point here is that the formula is set in advance and the company guarantees that specific amount. Now, as with all retirement account types, there are limits. For DBs, the limit is on the maxed promised benefit. It's capped at the lesser of 100% of the participant's compensation, averaged over their highest 3 consecutive years. Or for 2025, the limit is $280,000. This number is subject to cost of living adjustments, and it is included in exam tax tables, so you don't have to memorize it. Now, let's walk through an example. Denise, age 65, has received salaries of $90K, $100K, and $140K for the last 3 years. These were her highest salaries. What is her maximum benefit? Well, her 3-year average is 90 plus 100 plus 140 divided by 3, or $110,000. So her max benefit is either the lesser of 110 or 280,000. Since 110 is less, that is her max benefit. But what if Denise is highly paid with salaries of 260K, 280K, and 305K? Now her 3-year average is $281,667. Her benefit is limited by the universal cap of $280,000. And remember, this is a cap. Her actual payout might be less based on the plan-specific formula. All right, so we know how much money Denise can expect when she retires, but how does the money get there? Well, we already know that DBs are pensions, meaning that the employer is ponying up the money in mandatory contributions each year. The amount they contribute, that is a time value of money problem. Because the company already knows how much money they will owe Denise each month after retirement age, they can guess how many years Denise will live past retirement, and they can make some estimates around how much investments will grow between now and then. Now, don't worry, we are not about to do some crazy calculator math to solve for this. In fact, to figure out how much money Denise's employer needs to contribute to fund her and her coworkers' DB, well, you need an actuary for that. Actuaries are financial risk and statistics nerds who take upwards of 6 exams to be certified. For DB plans, actuaries come in each year to assess the mandatory employer contribution amount. They look at things like life expectancy of participants, expected wage growth, expected forfeitures if employees leave before becoming fully vested, as well as macroeconomic factors like inflation and investment returns. This is a multi-week project at a fairly expensive administrative cost to the employer. All right, one last thing I want to touch on DBs before we talk about the 2 different types, and that's insurance. Now, I know you've heard me say this already, but it's been a couple minutes, so I'm going to say it again. The beauty of DB plans from an employee's perspective is that they eliminate the biggest retirement risks, longevity risk and investment risk. Live to 100, you don't got to worry about running out of money. The company is on the hook to keep paying you. Stock market tank, no need to tighten the budget. The company still owes you the money. But the trade-off here is, well, you are relying 100% on the company. And yes, ERISA establishes guardrails and protections, but what if the company still fails? What if it goes bankrupt? That is where the Pension Benefit Guaranty Corporation, PBGC, comes in. It was established as part of ERISA, and as the name suggests, it provides insurance against DB pensions going belly up. Plans usually pay an annual flat rate per participant, and if they do go bankrupt, PBGC pays out participants. It's not 100% coverage, so if Denise's employer goes bankrupt, her payment is going to be significantly less. For reference, the maximum payout is about 70 to 80K. That's not something you need to know for exam. But you will 100% need to know that all DB plans, except for professional service firms with less than 25 employees, are required to participate in PBGC. Other plans, not covered. Okay, my friends, we are finally ready to talk about specific qualified retirement plans. Now, the beauty of all this is, since we've layered on the attributes of qualified plans, pensions, and DBs, this section will be short. Now, there are two types of DB plans: defined benefit and cash balance. Yep, you heard me right. Defined benefit is a type of defined benefit. Because if it wasn't hard enough, DB is the name of the category as well as a specific plan type. This is true also of profit sharing, by the way. Now, there's actually not much I want to say about defined benefit plans. They're basically the sum of everything we just talked about. Perhaps the one fact I will throw in here is that DB plans, they advantage older employees, including older business owners. Since DBs are capped on their benefit amount, well, you can establish a DB plan today and in just a few years, assuming the business has the cash, be paying a retiring owner a hefty amount of money. And that's because unlike DC plans, you're not capped on how much money you put into the plan. You're capped at how much money you pay out of the plan, which means DB plans are great for stuffing in a lot of tax advantage money in a short amount of time. And the other type of DB plan that exists is called a cash balance pension plan. Again, it has all the attributes of a pension and a DB, namely it's subject to annual employer contributions determined by actuaries. It promises a defined benefit. The employer is on the hook for investment performance, and it is subject to PBGC. Now, cash balance plans are defined benefit plans, but they kind of look like defined contribution plans from the participant's perspective. And that's because they provide a hypothetical account statement in dollars. These statements include pay credits and interest credits. The pay credit is usually a percentage of salary, say 4% of your current year's salary, and the interest credit is a guaranteed amount of interest earned on your current and past year's pay credits. It could be fixed, like 3%, or a variable rate, like the 40-year treasury. This rate is guaranteed. So if the plan's investment performance is worse than the guaranteed rate, well, the money will be paid by the company. But this rarely happens because the interest credit rate, it's typically set to a pretty conservative number. Now, you'll notice that when I described cash balance, I used the word hypothetical a lot. That's because while a cash balance plan statement looks very similar to a bank statement or a 401k statement, the reality is funds are commingled. There isn't a separate account for each participant. There's just one giant fund. But the cash balance statement more intuitively helps participants understand and kind of feel the progress of their retirement savings. The other hypothetical is pay credits. These are not the actual contributions the company is making on your behalf. The contributions, remember, they are based on actuarial valuations, just like DBs. It's a time value of money calculation. And the interest credits, also hypothetical. The real return on the retirement fund may be higher or lower, but you're always getting that guaranteed rate stated in the plan docs. So why go through all this work to have a cash balance plan? Well, instead of promising $5,000 per month for life, a company can promise we will contribute 7% of your salary each year and guarantee a 2% return. When you retire, you can take your account balance as a lump sum or convert it into an annuity. From the company's perspective, cash balance plans are much more predictable than traditional pensions. They know exactly what they're contributing each year, and they're only guaranteeing a modest rate of return. During the 90s, many corporations converted their traditional DBs into cash plans for this reason. All right, now let's shift gears and talk about defined contribution plans. In contrast with DB plans, defined contribution plans shift much of the onus of retirement planning from the employer to the employee. The employer makes a contribution to the plan based on a predetermined formula, say a % of your salary or a match on your own contributions, and that's it. The employee is now responsible for managing that money, and whatever money they have or don't have at retirement age, that's the employee's problem. Now, as a function of the employees now making investment management decisions, DC plans have individual accounts for each participant. This makes them much more portable as employees move from job to job. Now, there are two types of pensions that are defined contribution. Plus, there's all the profit sharing plans. They are all DC. Let's start with the pensions. The first one is a money purchase plan. This one's pretty straightforward. The employer makes an annual contribution to the plan based on a set formula, no actuaries. That's it. But wait, you might say, isn't this kind of like a 401k? In fact, it is. After 401ks came out, pensions tried to adopt some of the more attractive features. And in this case, the key difference between this and a 401k is that, well, this is a pension. So the employer is required to contribute each year, and most of the contributions come from the employer. Although money purchase plans, remember, are the only pension plans that allow employee contributions. The other type of DC pension plan is a target benefit pension plan. Think of this as a DC plan doing a little bit of DB light. Here again, the employer is contributing annually to the plan, but the amount they contribute is designed to target a certain amount at retirement. And by target, I mean, let's cross our fingers and hope it works, that kind of target. See, for target benefit plans, the actuary comes in and creates a contribution formula, much like they would do for a DB plan. They consider factors like age, salary, life expectancy, investment returns. But, and this is a very big but, they only do it once at the establishment of the pension. No refreshes, no updates. So it's a huge amount of effort to chart the course, but then if the weather blows you off course, no adjustments made. The pro of target benefits is that, like DBs, they favor older employees. To get to that target benefit for an older employee, well, you have to contribute more since they're going to retire sooner than younger employees. The con, well, do you actually expect to hit the target? Probably not. Might as well save yourself the actuary fees and the mandatory contributions and just do a profit sharing plan instead. Which brings us to profit sharing plans. Now, a quick reiteration, we are still talking about ERISA qualified plans, so there's still lots of administrative requirements to prove that the plan doesn't overly favor execs. But the benefit is we get to deduct employer contributions. We are also still in the profit sharing category, which means that employer contributions are not mandatory. They need to be substantial and recurring, but not every year. And finally, all profit sharing plans are DC plans, which means as the employer, you promise to make a contribution, but you have no investment return guarantees, nor do you have any promises about how much money employers will have at retirement age. All right, so there are 7 different kinds of profit sharing plans. Traditional profit sharing plans, age-based profit sharing plans, new comparability plans, 401ks, 403bs, stock bonus plans, and employee stock ownership plans, or ESOPs. We're going to touch on each of them. Why? Well, a guaranteed question or questions you will get on an exam is called retirement plan suitability, aka imagine you have a client who is a business owner and they want to set up a brand new retirement plan. Here are the requirements. What plan do you recommend? To answer this kind of question, you're going to need to know plan attributes, and in particular, the unique attributes of each. So that's what we're going to be focusing on here. Let's start with the traditional profit sharing plan. It's all the things we talked about. The company continues to contribute to the plan using a predetermined allocation formula. The formula can be a flat amount, a flat percentage comp, based on comp, age, years of service. It must be non-discriminatory, and it's capped at 25% of participants' compensation. Worth mentioning, most profit-sharing plans, well, they benefit younger employees since they are defined contribution plans. So younger participants, they have the advantage of more years of contributions and more time to compound. Now, the exception to this younger skew is age-weighted profit-sharing plans. These plans favor older participants. That's because the formula used to determine how much the employer contributes includes the participant's age or their years until normal retirement age in the formula. Now, this might seem a little discriminatory. Aren't older employees getting more contributions? But this is based on the idea that at retirement age, the ultimate benefit is equal. So age-weighted profit-sharing plans are best for business owners who are looking to maximize their retirement savings when the majority of rank-and-file employees are significantly younger. Another twist to traditional profit-sharing plans are new comparability plans, also called cross-tab plans. These divide employees into groups based on classifications such as job family, and then they apply a different contribution formula to each group. Now, as you might expect, the testing required to prove that these are non-discriminatory is much, much higher. But what it does allow you to do is to max out benefits for, say, owners and executives while making mandatory minimum contributions to the rank and file. Basically, if there isn't an age gap between the owner and employees, but you still want owners to receive a lot, this is your plan. Next, let's talk about 401ks. This is actually a feature that can be attached to a straight profit sharing or even a stock bonus plan. It's kind of like the GT version of a car. Still a Mustang, but a Mustang GT. What the 401k rider does is it allows employees to defer a portion of their salaries on a pre-tax basis to the plan. Note, there are Roth 401ks that allow for after-tax contributions, but we're going to ignore that for now. 401ks are also referred to as cash or deferred arrangements, or CODA for short. It's a fancy way of saying that employees can opt to be paid in cash or to make an elective deferral to a retirement plan. That's why on the exam, it often refers to the employee part of contribution as a deferral, while the term contribution refers to the combined employee deferral, employer contribution, and any catch-up contributions. Now, this is probably a good time to take a side tour and talk about the limits to employee deferrals. So far in this video, we've mostly talked about employer contributions. This is kind of our first time talking about how employees can contribute to their own retirement savings. For 401ks, as well as several other plans, employees can defer up to $23,500 per year. This number is on the exam tax tables, along with catch-ups for those over 50 years old and super catch-ups for those 60 to 63. It's on page 4. Remember, the innovation of 401ks is that they allow employees to fund their own retirement accounts, shifting a lot of the onus of funding to the employee. For that reason, while 401k employer contributions are capped at 25%, just like all qualified accounts, they rarely reach that level. Instead, 401ks often have employer matching. So the business might put in $1 for each dollar the employee contributes, up to say 5% of total comp, or maybe $1 for every dollar for the first 3% and 50 cents per dollar for the next 3%. Now, these employer contributions, they come with a vesting schedule. That's actually true of all qualified plans. Vesting means that employees must earn that employer contribution by continuing to work for a certain amount of time. We'll go into the details about how vesting schedules work as part of qualified plan administration. That's another video that's coming up. But what's important to note here is that any money the participant defers, that's 100% theirs. Funds from the employers, those are subject to vesting. Now, since we're talking about 401ks, the next type of profit sharing plan we should talk about is the non-profit equivalent, or the 403b. These are offered by public schools, churches, hospitals, and 501(c)(3) charities. Like 401ks, employees can defer salary pre-tax or post-tax through Roth plans up to the same limit amount. Again, there are catch-ups for older participants. The biggest difference from 401ks is that because the employer is a nonprofit, the employer match contribution is generally less generous. In fact, if the employer contribution is insignificant enough, it's possible that the 403b may actually not be considered ERISA. That's a can of worms we don't need to open up. Okay, we've got 2 more plans to go through. Are you still with me? Let's talk about stock bonus plans. These are profit sharing plans where instead of contributing cash, the employer contributes company stock. This can be advantageous because the company is not ponying up any money, so it can use its cash for other things like reinvesting into the business. There are, however, drawbacks. By issuing stock to employees, you dilute ownership, i.e. there's now more shares of the company, and the primary owners, they control a smaller percentage of the overall shares. Now, if you're sitting there thinking, this sounds great for the company, but is it good for employees getting stock instead of cash? And that is a good question. Equity ownership is great. It's how wealth is built. But if your retirement savings are now in a single company stock, that seems like a terrible concentration risk. It's good to participate in the growth of your company, but you don't want to have significant salary and savings exposure to the same company. That's why, as part of the Pension Protection Act of 2006, Congress required public company stock bonus plans to allow participants to immediately diversify, aka they can immediately sell the company stock. This is true of any employee contributions and generally true of the employer contributions. The taxation of the stock sales as well as distributions, that's somewhere we're going to cover in that distributions video. But for now, know that any gains on stock price while it's being held in the plan is taxed as capital gains instead of ordinary income like other retirement plans. This net unrealized appreciation, NUA, is a key advantage for employees if they do continue to hold some or all of that company stock. Continuing with the theme of company stock contributions, let's talk about ESOPs. These are a more complicated form of stock bonus plans. In the case of ESOPs, the company is profit sharing by giving stock to employees, except this is done through a trust. In fact, this trust purchases a substantial amount of company stock from the owners. Not only that, the ESOP trust can purchase those shares using a bank loan, making it a leveraged ESOP. This is a massive liquidity and estate planning benefit for the company owners. Not surprisingly, 99% of ESOPs are for private, closely owned corporations. All right, we are done. That was the overview of qualified retirement plans. Now, if you missed my video on Social Security or any of my other retirement planning videos, check out this playlist. I will be adding to it over the next few weeks. Good luck studying, and I will see you in the next one.